We're speaking with J Wrynn in the historic Hotel de Paris. It's a very impressive room. It's a bit noisy, but hopefully we can still hear what Jim, who was the Superintendent of Insurance in the state of New York and is now a partner with the law firm of Goldberg Segalla, has to tell us. Can we start maybe with what was the transition from being the Superintendent of Insurance in New York with a big law firm?
Well, I was very fortunate to have served as superintendent during very interesting and challenging times. There was so much going on, a lot due to a great extent to the financial crisis at the state, national, and international level. And I was very fortunate to have been very involved at each level. At the international level, I served as vice chair of the G Committee with the NAIC and a member of the Financial Stability Committee. And we worked on coming up with a methodology to identify systemically relevant companies and the measures that should be taken once identified. An initiative called ComFrame, the Common Framework for the Supervision of Internationally Active Insurance Groups, group supervision, international accounting standards, and so on. At the national level, we had the Affordable Care Act, which is now being implemented, and as of October 1 will be the date for open enrollment. The Dodd-Frank Act and all of its permutations, including the creation of the Federal Insurance Office. I was involved at the NAIC with the Solvency Modernization Initiative, which was a complete reassessment of the United States insurance regulatory framework, comparing it to international developments in banking supervision, insurance supervision, and international accounting standards for their possible inclusion in the U.S. system, as well as being very involved in the initiative that was to come up with a model law and regulation for the credit for reinsurance.
Okay.
And at the state level, a host of matters. New York, as you know, is a very busy place.
Yes, it is.
A lot of companies there. But in addition to that, we had several initiatives. One was to streamline and make the processes more efficient in the state. That was our Filing Modernization Initiative. And also legislatively, we worked and passed unanimously in both houses a life settlements bill that was enacted into law, a bill providing for the prior approval of health premium rates, and of course something that has not gone unnoticed, the creation of the new Department of Financial Services, where we merged banking and insurance to create a more comprehensive regulatory structure at the state level.
Okay. You mentioned something on the systemic risk, and everybody is fairly aware of that in the banking system. And there's a lot of debate in the insurance industry as whether really you do have insurance companies that are too big to fail, given that they came through the financial crisis fairly well, with one notable exception.
Correct.
What do you think?
Well, even with that exception, it wasn't the insurance activity that caused the problem.
Exactly.
And that's a big distinction between insurance and banking. With insurance, you don't have the liquidity and the leverage issues that you have in the banking side. And really, with the traditional business of insurance, which is a very conservative business with reserving, capital and solvency requirements, it does not have the potential to generate or amplify systemic risk as do many companies in the banking sector. But with that said, insurance is part of the overall financial sector, and a lot of the products that they're selling are becoming more complex and more capital markets type products.
Okay.
And with them, you have more capital markets type exposures. So even though the traditional business of insurance does not, in and of itself, generate or amplify systemic risk, some of the activities that they are now engaging could.
Okay, would that be true more for the life side of the business than property casualty?
It would, but we've seen with credit default swaps that there could be certain types of activities companies engage in the non-life side that could also be potentially systemically relevant.
Okay, well, When you joined Goldberg and Segalla, what type of things have you been working on with them?
Well, as I indicated, I was very fortunate with my experiences in a relatively short period of time on the regulatory side, and now I'm at the firm developing a regulatory practice.
Okay.
They had a small regulatory practice when I joined, and now we're trying to expand it further. And fortunately, my experiences at the state, national, and international level have given me opportunities to assist companies at each of these levels to try to avoid any regulatory issues, because that's the best scenario, to be proactive, to focus on the consumer so that you don't have issues going forward with the regulator.
That's right. On regulation, I know you're probably very familiar with Solvency II that the European Union has been working on for, well, I think it's going on about 10 years now. And it still hasn't been implemented, and some people think it never will. But there has been discussion of the idea of adopting some of the criteria of Solvency II in the U.S. Do you think that's a good thing, bad thing, or what?
Well, again, I was very fortunate. I was involved in one of the early U.S.-EU dialogues on Solvency II. It was very productive. I'm a believer that once you get into the specifics, you'll see that there's probably more in common that we disagree on. And that was the case here. I don't think there's anyone in the U.S. Who doesn't think Solvency II is a good initiative for the EU, but there are certain aspects of it that they feel should be more closely reviewed. Valuation issues, the use of internal modeling to the extent it's going to be used, certain investment type of proposals that have been made. But with that said, a lot of that would be Pillar 1 issues for the most part of the 3-pillar initiative. But Pillar 2, with the more qualitative type of focus that Solvency II provides, a lot of that has already been started to be incorporated in the U.S. regulatory system. So again, I think it is a good initiative, but there are aspects of it that really should be looked at so that you don't have unintended consequences going forward.
Yeah, and it would be very difficult given the fact that you've got now the federal government plus all 50 states more or less doing their own regulatory schemes. And I don't know how you can't really force them all to have one shoe, one size doesn't fit all, I don't think.
Well, we have a national system of state-based regulation, and we have an accreditation process, so every state has to basically follow the same rules with respect to assessing the solvency of the entities they regulate. And if they don't, they won't pass accreditation. And the system has worked. It's been around for many, many years, and we've had relatively few insolvencies compared to other sections of the financial services
very well,
industry. It has worked well, and that's it. Could it be more efficient? Yes, and that's what the NAIC is trying to do with all the commissioners, to try to work where they can to, again, streamline processes, create uniformity where you can, and it does work. And I think the proof of the pudding is in the success the insurance industry has had in the United States for many, many years.
Well, I know one event that you probably got involved in was Hurricane Nor'easter Superstorm Sandy. And what kind of problems were caused with something like that? Because, I mean, it was an absolutely awful catastrophe all the way along the shores of New Jersey and New York.
I was actually in the private sector at the time of Superstorm Sandy, but a short while before that, I was still superintendent at the time of Tropical Storm Irene. And what we were still with the department at that time. And what we did was we acted proactively. I actually shut down the offices in New York City, went up to Albany, so I was in Albany when the tropical storm hit, and we set up what's called the IEOC, the Insurance Emergency Operations Center, where after the storm hits, we get representatives from each of the major insurance companies into a room. We set up a computer terminal, telephones, whatever they need, so that we can collectively respond to the storm as needed, whether we need to send adjusters someplace, whether emergency vehicles needed, and it works very, very well. And I know the department did that with Superstorm Sandy, and I think the response of the department, considering the severity of the damage that Superstorm Sandy caused, was quite remarkable. But with that said, there's only so much you can do because the devastation was so great. But I think the department deserves a tremendous amount of credit for their response, as do the citizens in the affected areas, how they all came together to help each other out. And I got to give credit to the insurance companies who also did, overall a very remarkable job in getting the adjusters out there and addressing the needs of the insureds promptly.
Yeah, I think they got a lot of congratulations on the way they handled it. Well, Jim, you said this is the first time you've been to the Rendezvous.
It is. It is.
What do you think?
It's an amazing place. A lot going on, as people could hear in the background. But I will say, anyone who's anyone in the reinsurance world is probably here for this conference. And surprisingly, I'm in Manhattan, where my main office is, and I haven't seen people for a year, and I've met a lot of them here today. So I had to come to Monaco to see people who have offices down the block from my office. So it is a place to meet with people that you otherwise have difficulty meeting outside of the conference.
Well, good. Thank you very, very much for talking to us. And
thank you very much.
Excellent interview.
Thank you.